if you're an aspiring real estate investor right now, the stress of just trying to find a decent deal in this market, it's pretty intense. It often feels like you're looking for, well, a needle in a haystack, and the competition is just brutal.
Yeah, that anxiety.
Yeah,
It's definitely real
yeah.
and justified. But here's the thing. The good news, really, is that succeeding in this kind of market isn't about who spends the most money. It's actually found by dedicating your time and mastering some advanced techniques that focus on what truly matters, the seller's motivation.
I am Robert with Renee, and this is the Brick by Brick podcast, where we help beginners build wealth through real estate, one property at a time.
So today our mission is a deep dive. We're looking at how to avoid those classic, really costly mistakes that new investors often make. We're going to pull out the concrete strategies the pros are using right now to uncover those hidden opportunities, the ones that never even hit the public market.
Yeah, we want to equip you with the knowledge to stop overpaying. And we're going to show you exactly why success really starts with looking for a situation, not just, a pretty house. Plus, stick around because we'll reveal the specific and sometimes pretty expensive car parts you should be spotting when you're out driving for dollars. That one might surprise you.
Absolutely. Real estate investing success. It hinges entirely on preparation and having the right tools in your belt. We're going to cover that critical planning you need to make sure you don't overpay for an asset. And just as important, honestly, that you don't run out of capital before the deal even closes.
Okay, let's start with those foundations then, the failures. Every source we looked at really points to the same huge initial pitfall, failing to make a plan, like not deciding on an investment strategy and clear criteria before you even start searching.
Exactly. You absolutely must decide first. Are you going for single-family flips, long-term rentals with multifamily, maybe small commercial? You have to define your clear purchasing criteria first. If you don't, that anxiety kicks in. You might overbid, and overbidding creates this debt hole that can take years to dig out of. Not a good start.
And speaking of debt, the other big money mistake seems to be underestimating expenses, right? New investors just see the mortgage payment.
Oh, definitely. That's so dangerous because the mortgage, that's just the beginning. You absolutely have to factor in renovation costs, ongoing upkeep, insurance, property taxes. To fight this oversight, experienced investors use a really powerful filter right at the start. It's called the 50% rule.
Okay, tell us how that actually works in practice, because this sounds like something every beginner listening really needs to internalize.
Right. So the rule basically dictates you assume up front that 50%, half of the property's gross rental income, will just get eaten up by non-mortgage expenses. And this isn't just like long going. It covers reserves for vacancies, when you don't have a tenant chicken, there are property management fees, taxes, insurance, and those big-ticket capital expenditures down the road. Think a new roof, HVAC, water heater.
Wow, okay, so if a place rents for, say, $2,000 a month, you're saying $1,000 of that is just gone, right off the top for operating costs, before you even think about the mortgage payment.
Precisely. By applying this rule, you immediately force yourself to acknowledge that, yeah, expenses almost always cost significantly more than you first guess.
Yeah.
You only have the remaining 50% left to cover your principal and interest payment on the loan. Whatever's left after that is your actual cash flow. If the deal doesn't cash flow using the 50% rule, you move on. It's a discipline.
That's a really rigorous way to filter. Okay, so moving past the property-specific numbers for a second, you also need to become like a hyper-local expert, right? How does that local factor play into decisions once we have our financial filters set?
Oh, it's huge. Real estate is fundamentally local. That means you need to drill down into land values, home values, inventory levels really specific to your target ZIP codes. And beyond just the numbers, you have to match the property's features to who you want to rent to, your tenant demographic. So if you're aiming for families, you obviously need good schools nearby, low crime rates. If it's young professionals, maybe access to public transit and nightlife is more critical. Your whole investment idea has to actually match what that specific local market demands.
Okay, good points. Let's turn the corner now and talk about finding those deals, the elusive ones. In markets like this where prices just seem crazy high everywhere, you're saying the mission shifts. It's not about finding an affordable house, it's finding an urgent situation.
Exactly. A situation means finding a seller who is highly motivated, someone who needs to sell, probably quickly, and likely at a discount because of that need. We often hear these circumstances referred to as the 3 Ds in real estate: death, divorce, and disease.
Okay, the 3 Ds. But why do those specific personal crises almost always lead to such strong financial motivation for a seller?
Well, think about it. They often involve immense pressure, either legal or emotional, usually both. Death can lead to probate sales, or maybe heirs inherit a property they just don't want or can't manage. They just want the cash, fast, regardless of the condition. And disease, sadly, can create overwhelming medical bills, forcing a sale to raise funds quickly. These sellers aren't prioritizing getting top dollar, they're prioritizing speed and certainty.
Right. So we know we're looking for motivation, not necessarily curb appeal. How do we find these people off market? The classic low-cost method is driving for dollars, isn't it?
It absolutely still works. It's old school, but effective. But, and this is a big but, you only get out what you put in, and here you're funding it with your time. The real key is volume. You can't just, drive around for an hour, spot 5 messy yards, and call it a day. You really have to commit to building a substantial list. Think 500 to 1,000 distressed-looking properties.
Wow, 500 properties. That sounds pretty exhausting, especially if you're working a full-time job. What's the secret to making that time investment actually pay off?
Efficiency. You need to train your eye. Know exactly what visual cues signal a potentially high-cost repair. Something the owner likely can't afford or just doesn't want to deal with. You're essentially looking for problems that require major capital investment to fix.
Okay, let's get specific then. What are those expensive red flags? I mean, obviously, beat up garage doors, broken windows, maybe a tarp on the roof. Those are clear signals. But here's where our sources got interesting. What specific appliances or systems should you be looking for?
Okay, here's a big one. Look for window unit air conditioners.
Yeah.
Multiple window units especially. That's a critical signal because it often means the central HVAC system has completely failed. And that's not a cheap fix. We're talking $5, $10, maybe $15,000 for a replacement. So if the owner has resorted to sticking individual units in the windows, chances are they're delaying a major expense. They're likely quite motivated to sell that problem to someone like you, probably at a nice discount.
That's a great tip. Okay, so beyond literally pounding the pavement, intentional networking is also key, right? Our sources really emphasize it can't be just transactional. You have to focus on what you can give.
Yes, absolutely. And this is where you leverage professional relationships.
Yeah.
Often underutilized secret weapon here. Your local title company. Think about it. They're involved in every single real estate transaction in the area. They see everything. They know who's buying, who's selling, even landlords quietly selling off entire portfolios.
Okay, so how do you provide value to them? What's the actual incentive for a busy title company to pick up the phone and tell you about a potential seller?
It's simple, really. You schedule a meeting, go in, introduce yourself, let them know you're an active, serious, consistent buyer. And here's the kicker. You tell them you will close all your future deals through their office. Suddenly, you represent reliable, repeat business for them. That gives them a very clear, high-volume business incentive to remember you when they hear about landlords looking to sell multiple properties, often one by one, without ever listing them publicly.
That makes a lot of sense. A practical way to generate off-market deal flow. Now, what about online? Most beginners probably glance at Craigslist or Facebook Marketplace and just dismiss them, thinking it's all retail prices.
Yeah, and that's often a mistake born from inconsistency. The genuinely good deals on those platforms that get snatched up fast, usually by the people who are checking them daily, or at least several times a week. You have to systematize that search time, make it a habit. And crucially, look beyond just the obvious for sale ads.
Right. And there's a fantastic pro tip sort of hidden in the classifieds, checking the for rent listings.
Exactly. You should actively target poorly advertised rental properties.
Mm-hmm.
The ones with bad photos, minimal descriptions, maybe they look dated or run down in the pictures. Why? Because badly maintained properties often attract, difficult tenants. And a landlord who's frustrated, dealing with tenant headaches, maybe late rent, damages. That landlord is often surprisingly receptive to a clean cash offer just to get rid of the property, the problem, the stress. They start prioritizing peace of mind over squeezing out every last dollar.
Okay, so let's say we've done the work. We've found that motivated seller, we've got a potential situation lined up. How do we structure the deal? What investment vehicles or strategies are best suited for beginners, maybe people with limited capital?
Well, this really depends on your personal situation. Your risk tolerance, how much time you can commit active versus passive investing, and your goals, like are you focused on cash flow now or long-term appreciation? But generally for beginners, active strategies that let you maximize leverage and recycle your capital are often the quickest way to scale up.
And the two most popular active strategies we kept seeing mentioned for scaling efficiently were house hacking and the BRRR method.
Yeah, those are classics for a reason. House hacking is just an excellent entry point for first-time investors. You buy a small multi-unit property like a duplex, triplex, maybe a fourplex. You live in one of the units yourself, and then you rent out the other units. Often those rents can cover most, if not all, of your mortgage payment. It drastically cuts your own housing costs and gives you immediate passive income and landlord experience. Then there's BRRRR. That stands for buy, rehab, rent, refinance, repeat. This one's all about maximizing returns by recycling your capital efficiently.
Can you walk us through that BRRR cycle quickly?
Sure. So you start by buying a distressed property, often using those methods we just talked about, like driving for dollars or networking to find it below market value. Then you rehab it, force the appreciation by fixing it up, making it desirable. Then you rent out to a good tenant at market rent. Once it's stabilized and worth more, you go to a bank and refinance the loan based on the new, higher appraised value. This lets you pull out cash, your initial investment, plus maybe some profit. And then the final R, repeat. You take that cash you pulled out and use it as the down payment on your next distressed property. It's a powerful engine for building a portfolio relatively quickly.
Makes sense. Okay, let's quickly touch on the big difference between residential and commercial real estate because how you value these is completely different, right?
Yeah. Oh, absolutely. Totally different ballgame. Residential properties, so single-family homes up to 4-unit buildings, they're primarily valued using the sales comparison approach. Basically, what have similar properties nearby sold for recently? Comps. That's the main driver. A key advantage with small multi-unit residential, like a duplex or triplex, is it reduces your vacancy risk. If one tenant moves out, you still have income from the others.
Right. And then commercial real estate, that valuation is purely driven by the income it generates.
Correct. Commercial properties, think retail strip centers, office buildings, industrial warehouses, they're valued using cap rates, capitalization rates. The cap rate is essentially the expected rate of return you'd get if you bought the property all cash. You calculate it by dividing the net operating income, NOI, by the property price. Generally, a higher cap rate means a lower price relative to income, so potentially better cash flow. Now, commercial often needs more capital up front, but management can sometimes be simpler, especially with something like a single tenant net, an STNL property, where the tenant's lease makes them responsible for almost all the operating expenses, taxes, insurance, maintenance. The big risk there, though, if that one tenant leaves, your vacancy jumps to 100%, and finding a new commercial tenant can take much longer than finding a residential one.
Wow, this has been a really packed deep dive. We've covered avoiding those initial financial blunders, like really internalizing that 50% rule. We talked about scouting for those off-market situations using high-volume, low-cost methods like intentional networking and, yes, driving for dollars effectively. And we wrapped up by matching specific strategies like house hacking or BRRR to your capital and your goals.
Yeah, and what's really fascinating when you pull it all together is that almost every single mistake beginners make, whether it's overpaying, underestimating rehab, running out of cash mid-project, it all seems to trace back to, well, insufficient planning up front. And maybe most crucially, just poor valuation, not really understanding what a property is truly worth before making an offer. So the ultimate way to ensure you never overpay, which is really the root of so many problems, is to understand how the pros, the appraisers, determine market value.
Right. They don't just guess or go by gut feeling. Appraisers rely on three distinct objective approaches to figure out what a property is worth in the current market.
Exactly. First, there's the sales comparison approach. We touched on this comparing the property to similar ones that sold recently. This is the primary method for single-family homes and small residential. Second is the cost approach. This estimates how much it would cost to build a brand new replacement for the structure and then subtracts depreciation for age and wear. This is often used for newer buildings or unique properties like maybe a school or a church where comps are hard to find.
Okay. And finally, the method that should be like the gold standard for every single investor looking at income-producing properties, the income approach.
Absolutely. The income approach values a property based purely on its ability to generate cash flow, its net operating income, NOI. This is critical for multifamily buildings and all commercial properties because it directly reflects how other investors, the potential buyers, will value that asset. You really need to learn how to perform this valuation yourself, connecting it back to realistic expenses, like using that 50% rule, to make sure the numbers truly work before you ever make an offer.
So wrapping this all up, what's the big takeaway for the listener who's just starting out feeling maybe a bit overwhelmed?
It's this. By taking the time up front To learn these objective valuation methods, sales comp, cost, and especially income, you stop gambling. You stop guessing on price. You start ensuring that you actually make your profit the moment you buy the property by buying it right. That upfront diligence, that preparation, that's the only reliable key to building sustainable wealth in real estate.
If you got value from this podcast, hit the like and subscribe and keep building your real estate foundation brick by brick. This podcast was sponsored by Riverside-Realty.com.